I'm a chalkboard person, so we'll be drawing up here during the course of the session. But what we thought when we were first trying to talk about this program was we have 45 minutes today, we have an hour tomorrow. We thought it made more sense to break it into two pieces. Today will be basic estate planning. We'll walk you through some of the elementary stuff that you should have in place and things that you definitely want to do. And then tomorrow's advanced estate planning. We'll start walking through some of the additional games that can be played, the things that get tax attorneys excited. And so if today is too basic for you, feel free to say, I want to get out in the sunshine, take off, and come back tomorrow for the more advanced material. I wanted to put it together in a form that would be something of a flow chart for you, so that you walk through. That's why we've passed out these materials, which will be the equivalent of slides, but I'm going to draw them because I think they sometimes make more sense as you see them develop on the screen. But there are multiple enhancements of the basic design and what is sort of standard planning for any estate planning couple who goes into this material. And so let me plunge in and start with the first issue, which is what are these instruments that you should have? And the traditional has been the will. Everyone knows you write a will. Well, you really don't want to write just a will anymore. The primary estate planning device is the Revocable Trust or the Living Trust. You've heard this on the advertisements. Come to our seminar, learn about Revocable Trust, save taxes, and so forth. And it really is the device of choice. And in California, for those of you who are from this state, absolutely. And there's an expense reason involved. 15 years ago, I told clients, write a will, write a revocable trust. There's a trade-off. You spend more time and expense today writing the trust and transferring assets into the trust. And the idea is to save money in the long run. You save money in the probate and administrative costs, the legal fees and court costs, when someone becomes incompetent or dies. Well, that's sometimes a long way off into the future. Discounted present value of those savings are computable in some sense. And you weight it against the savings that the costs that are involved now in doing the revocable trust. It was a wash most of the time. Well, our California legislature and our Congress changed that. California used to have an estate tax. It was a piece of the federal tax. So if there was a federal tax due, California got a portion of it called the state death tax credit. And California repealed its inheritance tax and created what they called a pickup tax. They said, our estate tax is whatever you get when you have a state death tax credit. So just send us the federal return and a check for whatever is due. And so the total tax was always the same. It's just a piece of it went to California. In 2001, when they passed the major tax change, they repealed the state death tax credit and turned it into a deduction and then phased out the credit over several years. The California rule was established by a statewide vote, so it couldn't be changed by the legislature alone. The result was we no longer have a California estate tax. It's disappeared, along with the money, which now goes to Washington. And so the legislature said, gee, this is a problem. We've got to try to collect some of this money. So the first issue is, well, can we pass another estate tax in California? And, of course, the answer to that is not a chance. And so they raised the filing fees for probate. And they made it a percentage of the gross assets. So traditionally, you would pay maybe $100 to $150 to file a will for probate. Now, it's 0.2% of the gross assets. It's a disguised estate tax. And they passed it, and they made it. I guess they thought they were making it judgment-proof because they made sure that the funds went to the judges' funds. And so, I told people I thought it was a disguised estate tax. I thought it was a violation of the statewide vote and probably could be challenged. And if you get a large enough estate, there'll be enough money at stake. Well, this week, for the first time, I got an email where they have found a class action lawyer, a law firm, and they're looking for a lead plaintiff to take on this fee that has been imposed. And you may very well see this overturned. I think if they may have to go into federal court. State court judges may not agree, but I think we may see this change. But in the meantime, the cost of simply filing the will for probate far exceeds the marginal additional cost of doing a revocable trust. So, first item on your list is the document you want is the revocable trust. This is where you write your estate plan. You still have a will, as you'll see, to back it up. But this is really the instrument everybody uses now, especially in California. And I recommend it to everyone, sort of no matter how large the estate or how young the clients, this is the way to go. Saves you administrative time, saves you legal fees, saves you court costs, saves you these filing fees, saves you referee fees. It goes on, and it's really the right way to go. The trick is what you write in this. And that's the heart of what we're going to be talking about today. You begin with the estate tax. I tell clients there are actually 5 different taxes you have to worry about when you do planning. Income tax, gift tax, estate tax, generation skipping tax, and property tax. And they are not coordinated. So you can trip over one while you're trying to work with another. You have to go through any action you take. You've got to flip through all 5 taxes to make sure you've got it done correctly and without some mistake. But the estate tax is really the main one. And it's a relatively simple tax. If you go to diagram 2, this is for a single person. For estate tax purposes, the IRS really likes you because you're taxed the worst of everyone. The way the tax works is you do it, it is really simple. Add up the fair market value of everything you own. Clothing, jewelry, furniture, cash, securities, real estate, IRAs, 401ks, life insurance proceeds. You literally add up everything, fair market value. Subtract out the debts, and you get a net worth. That's my rectangular box. There is a piece of that that is free of estate tax, no matter who you give it to. That's what I call the tax-exempt portion. The bottom piece, you start counting from the bottom up. Today, that exempt portion is $2 million. But it's changing. It's on a roller coaster. For the next 2.5 years, it's $2 million. In 2009, it goes to $3.5 million. In 2010, that's the year of the so-called repeal. It's unlimited. No matter how much you have, no estate tax. And in 2011, it comes back down to where it was in 2001, which is $1 million. Up and then back down. If your estate is over $1 million, then you have to file a return, and you may or may not have a tax depending on what you do. If you're under $1 million and you're single, you don't have an estate tax problem. You have other issues to deal with, who you give it to, who's going to be in charge, which the revocable trust handles. But the estate tax is not a problem for you. And it's not a California estate tax either, because that's gone. So when you're looking at the planning, most of estate planning is tax-oriented, but there's a whole group of people who fall into the under the tax-exempt limit who do estate planning for other purposes. What if you're over that? Well, this is where you really get hammered. The tax rate, since I find it hard to multiply it by either 46% or 55%, I tell people it's basically half of what's left goes to the government. It's a round numbers, 50% estate tax. Right now it's 46. It's going to drop down to 45. And then in 2011, it bounces back to the old rates, which range up to 55%. Highest rates in the code. So when you get into the estate tax range, it's brutal. It is really painful. One of the questions that comes up is, gee, Bob, aren't they going to fix this? I was over listening to the questions on Jim Patel's program, and there was a lady at the end who was suggesting, well, gee, do you think you ought to bring in maybe psychologists and sociologists to assist in your programs in these developing countries, and maybe politicians? And there was this groan from the audience. I think our Congress is held in low esteem at this time. And part of it, certainly in the estate planning community, we looked at this thing in 2001 and we said, well, this is clearly a temporary bridge. They won't leave this mess alone. They'll fix it. That was 5 years ago. I look at it now, and I think there's a good chance we will continue to have gridlock on this thing. And part of the reasoning is there's an incentive for both parties not to negotiate. This summer, the big effort to try and come up with a compromise, and the Republicans said, we'll give you minimum wage, you give us significant reduction of estate tax, $5 million exemption, and lower brackets, 15, 30%. And the Democrats said, we'll give you your repeal, but we get minimum wage. So they had an extra incentive for both parties. They got something they wanted, but they had to compromise and give something to the other side. And they couldn't get the votes. They couldn't bring it together. For the Democrats, they look at it and say, you know, if we wait till 2011, we lose 1 year's estate tax. But then we're back into a bargaining position that was the same as in 2001. We have a stronger position to negotiate what we want. We'll either get some other trade-off if we give them reduction in estate tax or something else, but we're in a stronger bargaining position. The Republicans look at it and they say, you know, we've carried the flag. We got a 1-year repeal. We've done our best on this. We can go to our groups who support this and say, we've tried hard. It's those Democrats who are stopping us. And in the meantime, they pick up an extra 40 or 50 billion a year, which is really handy in Congress, at least at this time. And so I look at this and I say, why? What is it that's going to move them to compromise? I think you have to realistically look at the statute as it's currently written and realize it may be there. And since most of you that I see look in pretty good shape, you're probably going to make it to 2011. So, you know, there's this very small window of 2010 that you make it past and you're okay, but then you're into the higher tax. If they do change it, I mean, they've done all kinds of things back there. I don't know that it'll come out to something sensible. It struck me that getting rid of the estate tax for the great bulk of people so they don't have to spend money on estate planning attorneys and so forth is good social policy. Notwithstanding the loss of income that goes with it. But the number of people who are affected by this tax is really much larger than the number who end up paying it, because they've got to hire the planners, the attorneys, the accountants, the investment advisors to try to get themselves out of this tax or reduce it. So it goes much beyond the 0.5% who end up paying any tax on this thing. It affects kind of a broad portion of society, and it really requires a lot of planning. And we're going to tell you a little bit, some of that planning that you get to do. So that diagram number 2 gives you the idea if you're a single person. One way to get rid of the tax, though, that's really nice, and this is a short word from our sponsor, charitable giving is deductible. Anything off the top comes down and reduces your estate tax. Now, there's a cost to the other beneficiaries, but it's only 50 cents on the dollar. So there are really admirable institutions out there whose names you can probably think of, and you can. So if you're a single person and you're looking to reduce the estate tax, obviously charitable giving is one of the ways to go. And I'm going to mention one other device that's really, it's not just a 50% cost saving, it's 75 cents that doesn't go to the government, and we'll talk about that later. Now let me go to the Revocable Trust. And go back to diagram 1 for a second. Simplistic, but for a typical couple or a single person, you have a revocable trust, but you still have a will. It's what's called a pour-over will. And it says the revocable trust only works on assets where title has been changed into our names as trustees. If it's not in our names as trustees, then it's a probate asset and is controlled by the will. So the will says, I hope I put everything in that trust, but if I missed and I left something out, fine. When you're done probating it, as you will have to do, distribute it to the trust, and then the trust distributes the assets in accordance with its terms. As a question, how many of you already have revocable trusts? Show of you. This is, okay. We're way ahead on this group. You've been told the reasons for it. Now, what you write in this thing. This is where I want to lay out the basic plan that you typically have. So you start with your revocable trust, and you hold, hopefully, all of your property other than qualified plans, and I'll talk about those in a little bit, in the name of the trust. While you're alive, you run it just like you're doing now, all of you who have it. You spend the money the way you want. You control it. You don't even file an income tax return for it anymore. You just report everything on your individual return. If you're still filing an income tax return that says everything's on my individual return, you can stop that. They changed the reg on that. So now we don't have warehouses filled with empty returns. Until someone dies, it just operates as a title holding device. It's really not visible or effective for anything other than avoiding probate court if someone becomes incompetent or dies. When the first spouse dies, then you split it into the two shares. We're starting with diagram 3, and you'll see how these hopefully flow together. Well, you've got the deceased spouse, their share, and you've got the surviving spouse's share. You split it. Now, what is the deceased spouse's share and the surviving spouse's share? It's, for Californians, we have both community property and separate property. Separate property belongs to one spouse, does not belong to the other. They control it, they dispose of it. Community is owned 50-50. Each owns half, each disposes of half. So the deceased spouse's half is their separate, if any, and their half of the community. And the survivors is their separate property and their half of the community. And what happens on the first death is that gets divvied up. It's into shares, or at least theoretically. When you do the distributions, you don't actually split everything 50-50. You can do them non-pro rata. But the idea is, in value, you've got two portions. And then the question is, what do you do with this piece, survivors? Well, the traditional basic plan is the survivor's trust, which is just an ongoing revocable trust. It's just like the revocable trust before. It's the survivor's property. They're the trustee. They can revoke and amend it. They can spend it any way they want. It's their property. That gets set up. The real planning is what happens with the deceased spouse's share. And in the basic plan, you split it into two pieces. The first piece is everything of value all the way up to whatever the exempt amount is at the time of death. Right now, $2 million. In 2010, it's unlimited. So Warren Buffett can put all $40 billion over here if he wants that year. Whatever the exempt amount is, that passes free of tax. Now, what do you do with it? Well, you put it into an irrevocable trust. Typical name for this is bypass trust. It goes by the name B trust, exemption trust, credit shelter trust, family trust. All these different names are just synonyms. It's an irrevocable trust that is held for the survivor's benefit for their lifetime. And why do you do it? Because it's written so that when the survivor dies later on, they are not considered to own this trust for estate tax purposes. So it passes free of estate tax on the second death to whoever the designated beneficiaries are, including any growth, appreciation in the assets that went into it originally. So if you can put $2 million in here when the first spouse dies, and you find Google 2, and it's $4 billion when the survivor dies, the entire $4 billion goes free of estate tax. It's a wonderful little black box tax shelter. First question is, well, that's fine, but what kind of benefits does the survivor get? And this is what's great about it. It's incredibly flexible. You can have all four of these characteristics, and it still won't be subject to estate tax. The first is the trustee can be that surviving spouse. They can be the sole trustee of this trust. So they can manage the property, invest it, and make any trust decisions that a trustee would make. Second, all of the income can go to that spouse. Interest, dividends, net rentals, or use of property. Very often, we'll fund this with all or a portion of the house. And they have the right to live in it, rent-free. They just use it. And that's fine. If it's funded with investable type assets, all of the income can go over to the survivor. If that's not enough, as trustee, the survivor can invade the principal of the trust for their own health, maintenance, support, and education. In their view, they're the trustee. I tell people, if you can't fit something under that, call me. We'll work on it. We'll find a way to fit it under one of these headings. There actually is no tax definition of these things. It's a Webster's Dictionary kind of lookup. We actually had somebody ask, well, is there any tax case that defines what these things are? And the answer is no, not really. They're words of art. They're in the statute, and they work. Bad words are comfort. You can't be comforted. Welfare. No welfare. But if you use the right words, health, maintenance, support, and education, you're home free. You can invade the whole thing. Now, who's going to complain? It's not the IRS. The IRS says, if you leave the assets in here, we do not get to tax them. The people who complain are the folks who come after surviving spouse. Typically ungrateful children. They say, Dad said health, maintenance, support, and education. Mom says a Ferrari. This is where the fourth power is very important, because those kids can go to court. And they can say to the judge, tell Mom to put the money back in. The fourth power, this is typical of lawyers. This is an irrevocable trust. The fourth power gives the survivor the right to change the ending. This sounds inconsistent. Lawyers have no problem holding inconsistent thoughts at the same time. So the words can't be changed, but within the words, the survivor can have a special power of appointment. It's the right to change who the beneficiaries are to anyone in the world except their creditors or the creditors of their estate. Usually not high on anybody's list of beneficiaries anyway. And so when child objects, parent says, don't worry. You're no longer a beneficiary. It's all going to your sibling or the SPCA or whoever you want to send it to. When you look at these four powers, you manage and invest it. You get all the income. you take out the principal if you need it, and you get to say who gets it when you die. That's full control. What else is there? So this design is the equivalent of all to my spouse, the old traditional plan, but it has the advantage of no tax on second death. And that's why people do it. They wouldn't write a bypass trust many times if they could get around this problem. But they write it because they can get the equivalent of full control and get the tax benefit. Now, an interesting aspect of the compromise that was put in this summer was to give people the right to bequeath this exemption so that you could hand the exemption off to a spouse and avoid having to set up the bypass trust. Since that went down to defeat, it hasn't been studied a whole lot, and there may be some really complex problems that we may run into in how we deal with that. Can it be bequeathed twice to the next one? What if you have children as beneficiaries, so forth? I think it probably will come up more in those circumstances where people have not done their planning, and this helps them save them from having an extra estate tax. But know that that's one of the things that was put out there. Now, this is your basic plan. You end up, after the first death, this trust goes away, and you end up with two trusts, and the surviving spouse still controls everything. Let me take you to the next step. Go to diagram 4. Now the survivor dies. We've already touched on part of this. This is when the IRS becomes a beneficiary. When survivor dies, basically half of everything over $1 million goes to the IRS. That's when they really get their cut. As we said, at 50%, it can be a huge amount. It may be even more because what if you have more than $2 million in here? The excess typically is given to that spouse as well. The reason that excess is given is because anything passing to a spouse who is a U.S. citizen is free of estate tax. Unlimited. It's like a charitable deduction, and it's called the marital deduction. So wherever this dividing line occurs, the excess is typically given to the survivor's trust. But as you can see, that's not an elimination of tax. That's a deferral. All you've done is put it off until the second death. Well, that's still pretty good. You've had the spouses have the availability of the entire estate during their lifetimes, and it's only when the survivor dies that the IRS steps in, and who really bears the tax are those ungrateful children. Down here, they're the ones who really bear the tax. So most of your estate planning is altruistic. You two don't feel the tax. You're gone. It's these people who are encouraging you to go see the estate planning attorney. And when they come around and say, we'd like to suggest you maybe go see the lawyer, and we have some good ideas, they're looking at this. They know it's going to be horrendous. Survivor dies, half of everything over $1 million goes to the kids, and this piece comes down no tax because of the way the trust is written. What if the children are young? Or older but still financially incompetent? We've never run into that. We're not ready to hand a whole bunch of assets over to these kids. They're just not able to handle. We need to manage it for them. Well, that's what we call a separate share trust. It's just a jargon term. It means whatever share is going to go to a child doesn't go outright. It goes into a trust. The trustee manages it for them, financially competent aunt or uncle, or friend or bank, someone other than the child, typically someone other than a sibling, too. Nothing to set kids against each other to assure family discussions of a heated type than having one sibling telling the other one you can't have that. Who are you? How many of us have heard sibling arguments? And so you often try to get an independent third party who maybe has the respect of the child or at least has financial and administrative capability, and they run the thing. And then the property comes out. A typical scheme would be, gee, they get half at 25 and half at 30. Before that, the trustee can spend the whole thing for health, maintenance, support, education. So you get them through school, you take care of medical problems, but they get control at designated ages. And the reason you do typically a split is the learning process. If they blow the first round, hopefully by the time they're 30, they've gotten a better attitude toward maintaining capital. Some clients look at it and say 25 was a great year. 30 is going to be another one. I'm looking forward to it. Thank you, Mom and Dad. Can't wait. Others, there's a maturing process that goes on. Early 20s, still learning about money, haven't learned how little is left after income taxes and FICA and everything else, living expenses. By 30, often either have been in the workplace for a while, may be married, may have a family, may have a mortgage. All these things bring a different attitude toward what life costs and what a capital fund looks like. And so it's nice to spread this out. It can be any age. It's up to you. The longest one I had, gentleman was in his 70s. His was distributed at 55, 60, and 65 to his son. I think there was something else going on there, but you can also look at it as, gee, things go wrong in life, and I don't think the personality of my child is going to change very much, so I'm going to spread this over a long period of time, and I'm going to give them slices over time, things like that. It's some element of trying to make sure that there's financial security, knowing that if it gets out into their hands, it may not be financially well handled. But it's up to you to look at it. If you have mature children, you say, why do we need these trust funds? They're all over 25. They all have their MBAs. We want them to manage our money. We'll give it to them right away. We don't need a separate shared trust. And so depending upon age and maturity, you may or may not have these trusts. This, again, standard plan. That's what diagram 4 is. You get that done, and you've done some very good estate planning. You've done the equivalent of the traditional nuclear marriage. We want it all to stay in the family, and we want to save estate taxes and pass it on down. What if you don't have the traditional nuclear marriage? What if it's a his and hers marriage? Children by prior marriages. Well, the problem is, if you give all this excess to the spouse, they'll give it to their children by their prior marriage rather than your children by your prior marriage. And the client says, well, I want to provide for the spouse. I want to avoid estate tax, but I want to be sure my share of the estate ends up with my kids by my prior marriage. So Congress gave us the solution. Get rid of my drawing. And the jargon term is QTIP trust. Stands for Qualified Terminable Interest Property Trust. Everybody calls it QTIP. Those of you who know trademark law, you have to defend your trademark or it becomes part of the public domain. And so when this thing was first passed, there was an advertisement in the Wall Street Journal that said, Johnson & Johnson, please request all estate planning attorneys to refrain from using the term Q-tip. And you had to know what they were doing. They were able to take this card to this advertisement to the court and say, we tried. We really tried to defend things. But it's called a Q-tip. Everybody calls it that. The gist of it is, when the first spouse dies, they send the excess to the Q-tip trust, which is an irrevocable trust. They don't give it to the spouse. It's written so it qualifies for the marital deduction, so there's still no tax on first death. It has a couple of requirements. All of the income has to go to the survivor, and nobody else, including children, can be a beneficiary while the survivor is alive. But if you do that, it qualifies for the marital deduction. And then this spouse can say where this goes on second death, not the survivor. And what happens then is a little variation on the distribution. Here are the surviving spouse's children. Here are the deceased spouse's children. When the survivor dies, the bypass flows down here, the Q-tip flows down here, and the survivors flows to their children. So you've been able to dispose of the two shares of the estate down to the people each spouse wanted to benefit. What's the bad aspect of this? Well, when the survivor dies, this is treated as if it's owned by the survivor for estate tax purposes. So the estate tax consequence is exactly the same as an outright gift. They add these two together and then compute the tax. So what happens is half of the Q-tip goes to the IRS as well. It's piled on top of the survivor's estate. And the benefit is you deferred the tax. The detriment is it finally gets hit on the second death. But that allows you, in the what is becoming a more traditional family, the blended marriage of children by prior marriages, to still get the same plan, the same tax planning, and the same tax benefits. And that's laid out on diagram 5, the Q-tip trust, and on diagram 6, what happens when the second death occurs, the flow down. Two very basic kinds of plans. Now, Q-tip isn't always used with blended marriages. Sometimes there's disagreement between the spouses in the nuclear marriage about either who this goes to or at what stages. One spouse thinks the children are fine, deserve all the money right away. Other spouse says not a chance. Or this spouse says, I want more than just the children to benefit. I've got other beneficiaries. And this spouse says, oh, I don't agree. And this spouse, the first one to die, doesn't want to take a chance that those plans won't get implemented. So this is a control device for more than just blended families. It can be a control device in nuclear marriages where it isn't clear it's all going to go to either the same set of children or the same set of beneficiaries. Each spouse can still control the plan. And to the extent they want to control it, they can play with this set of rules. This is the broadest you can write it. You don't have to write that. Spouse may say, oh, last person I would put in charge of running the money is my spouse. I don't want to have them in charge. I want an independent trustee. I also don't want them making decisions about invading principal. They will. I want to protect them. I will give an independent trustee the power to invade principal, but I don't want to give it to my spouse because they might abuse it. It's the guru problem. The guru needs a new temple. Oh, I know just where to get the money. Or the spouse may say, look, I don't want to maintain an elaborate lifestyle. They have their own separate property. Medical emergencies, fine. Anything else, no. I'm going to limit what you can invade principal for. And special power of appointment, well, first thing, I'm going to limit it only to the family. No guru. No new spouse. And maybe I'm going to limit it to a piece of the trust. I want to know that some piece goes down to the children. Or I'm not going to give them any power at all. It goes down to the kids and that's it. Nobody can change it. You have a dilemma. There's not a right answer here on this. The greater the flexibility that you build into this or this, the greater the ability of the survivor to meet unforeseen circumstances. The bankruptcy of the child, so that if the money goes to the child, it goes to the creditors, not to them. Or the IPO, and the child says, don't send it to me. Bob's telling me to get rid of my estate. Send it to the grandchildren. Do it some different way. Things change between first and second death. If you've got great flexibility, you can meet those changed circumstances. Or it might be abused, and it ends up going to the guru. The greater the certainty, the greater the risk that it won't be appropriate when the time comes. The child, we've seen this, is in drugs. And if they get the money, they're going to kill themselves. They're going to go down to the motel, shoot up, and that's it. They're gone. How do we stop it? How do we prevent this money from flowing out? It's 15 years later, different world from what was written originally, and nobody can stop it. It's built in stone. So you look at that spectrum and you say, there isn't a right answer here. There's a judgment call that you make in terms of how much authority do I want to give the spouse or any other person who you give the power to change things. How much do I want to have it written so I know what's going to happen? Knowing there are risks and benefits on both sides. And that's the hard part of the hard part of estate planning that you need to go through. Now let me take you one step further. This is second death. Property goes down, and here, bear with me, I'm going to skip down to this as well. What happens when the kids die? Well, whichever way you do it, to the two sets of children or all to the children, to the extent they get it, when they die, the IRS says, great, give me another round. Okay? I got them when the parents died. I'm going to get them when the children die. And I will have a second estate tax at that level, and what's left comes down to the grandchildren. And in fact, this works every generation. This is the IRS ideal. Work hard, save your money, and give us half of it in the end. And do it every generation. Well, you know, having generation after generation, a fourth, an eighth, whatever the estate was gets shrunk pretty dramatically over 2 or 3 generations. Question is there anything we can do about that? And this is where we have another game. And this is a game I recommend to just about everybody because it's sort of a why not. The question is, can we do something like a bypass trust for the children? And the answer is yes. This is what's called the generation skipping trust. We used to play a game like this. Parent, child, grandchild, great-grandchild. The old pattern is everybody sends it down the line, and every generation you pay an estate tax. So you lose half. And when there's enough money and the children are well enough off, the game we would play is, hey, skip the kids. You still got to pay an estate tax, but send this estate to the grandchildren and send this estate to the great-grandchildren. You haven't avoided estate tax. It's still imposed. It's just cut in half the number of times the IRS gets its cut. So the family wealth stays together for a longer period of time. The IRS said that's a loophole. We aren't getting that second tax. We said, yes, that's why we do it. And whenever you get smart alecky with the IRS, they give you a new tax. So they gave us the generation skipping tax to get the equivalent of that. Now, the way it works is this way. At the margin, the estate tax is 50%. You compute that first and pay it. Now you're looking at the net after tax. And the IRS said, that's fine, and out of that 50% that's left, if you try this game, we'll hit you with another 50%. So we get a combined 75% tax on that. We're getting our second tax. Well, they were vicious because they not only got their second tax, but they got it earlier. With the estate tax, they had to wait till the child died. With the generation skipping tax, they got it when the parent died. So they got it a generation earlier. Well, if you figure 30 years for a generation, discounted present value of 30 years of money, it's 100%. It's the only confiscatory tax in the code, and it's disguised. It's really slick. I mean, you got to give them a lot of credit for coming up with 100% tax and not telling us. Why do I tell you this? Because the reason we pay Congress so much money is to give us loopholes. They created a second exemption. The estate tax exemption is up there, the million. This is a second exemption for generation skipping tax, computed separately. They said, out of this 50% that's left, we'll let you send the first $1.5 million per parent down to the grandkids, and we won't hit you with the second tax. Anything over that, 75% right away. People look at this and they say, Bob, we don't know if we have them all yet. I'm not sure I want to send that amount of money down to the grandkids anyway. The kids may need it. This doesn't do us any good. I don't want to send money down to the grandchildren right away. And that's where the generation skipping trust comes in. It's a trust for the benefit of the child or children, one each. You take the exemption and you split it up so that the children share it. It's irrevocable, lasts for their lifetime. It gets funded partly from the bypass trust, partly from the Q-tip trust, and partly from the survivor's trust, to the maximum we can stuff in there. Round numbers, $3 million. And then it looks a lot like a bypass trust because the child is the trustee when they're old enough to do it. The child can invade the income and the principal for their own health, maintenance, support, and education. And when the child dies, they have a special power of appointment that allows them to control where the property goes at their death, just like the spouse could with the bypass trust. So if their children, the grandchildren, are problems, they can tie it up in a different way than Grandma and Grandpa originally designed. It's a bypass trust for the child. Couple of benefits. First one is it's pretty well protected from creditors. So if they get into financial difficulty, they've got a pot to go back to. This money is accessible. This is what they got outright. This money, the creditors have a harder time getting into. It's also not part of the marital property. If the marriage dissolves, this isn't part of the marital settlement. It's separate and off the board. It's a starting point for them. And the reason tax attorneys love it, when the child dies, just as the bypass trust was free of estate tax when the spouse died, the GST trust is free of estate tax when the child dies, including anything it's grown to. And it passes down to the grandchildren and doesn't get hammered by the 50% estate tax. So I look at this and I say, what's the burden? Well, the child has to keep a separate account, and they have to file a tax return for the trust every year. Same thing you have to do with a bypass trust. It's not a big burden. We all have IRA accounts or whatever. And once the return gets started, it's pretty straightforward. Bottom line is, you've got $3 million, which hopefully they're not touching, letting grow because it's just a reserve fund, but they can touch it if they need it. And it passes down free of estate tax, including all the accumulations over their generation down to the next generation free of tax.
How do you get $3 million?
1.5 from each spouse. Yeah. So the gist of it is you can take the first spouse's 1.5, we can designate it, that ultimately flows down, including growth. So it might be a whole lot more than $3 million, because if this thing grows during the survivor's lifetime, all that can flow in here. Could be a whole lot bigger. And the end result is an estate planning device for the family that allows you to pass this stuff down off the estate tax table. If these people exist before the grandparents die, you can play the game for another generation. And so these trusts flow into generation skipping trusts for the grandchildren, don't get distributed until the grandchildren die, don't get taxed again until the great-grandchildren die. You can get 120 years of estate tax freedom for this pot. There are things called dynasty trusts, which in appropriate states, this can go on forever. California doesn't allow them to go on forever, but you can set up trusts in other states. But the gist of it is taking it off, writing trusts where the family, each generation has basically full control, but it's just not subject to estate tax. Why not? Some people say, well, how much flexibility do the kids have? Can they buy a house? The answer is sure. You can buy a house with the assets. You can hold title in the trust. They have a right to reside in any property held by the trust. We typically tell them don't do that, though, because when they sell, the trust is not eligible for the $500,000 capital gain exclusion on sales of houses. That's only for individuals. So what you do is you use this as your mortgage lender. You lend the money to the child. They buy it in their own name, and they pay the interest and principal payments back to the trust. And they pay a really high rate of interest because they don't consider themselves creditworthy. And the interest is deductible and goes into a pot that is going to be free of estate tax. It's the closest thing I can get to a deductible gift. And so the flexibility is there. It's a pot under their control. It's the equivalent of an outright gift. It's just not subject to estate tax. And that is really your basic estate plan. This is the kind of thing you design in. And it's it isn't a matter of how large the estate is. If it's a $100 million estate, I can still only stuff maybe $3 million in here. You still got a $97 million problem. But the fact that it's a $4 million estate, we can probably hide everything for the next generation because we can stuff it all inside the GST trust. And you're outside of the estate tax system. So the only issue is, well, gee, if we're so small an estate that we don't have an estate tax anyway, Bob, why do this? You shouldn't. A pain to run trusts and so forth. If you don't have an estate tax, you don't go through all this planning. This does not control one set of assets. The trust controls everything that's in the trust, but life insurance, controlled by the beneficiary designation, qualified plans, controlled by the beneficiary designation. You want to make sure you coordinate those with your plan. This is where a lot of times people drop the ball. Oh, it's a pain. Follow-up is awful. You make sure the life insurance is payable to the trust. It flows in. It's just part of the assets and gets distributed according to your plan. Simple. And every time you change your plan, you don't have to change the beneficiary designation because it's all flowing into the trust. Qualified plans are different. They have a special income tax rule that says if the distribution goes to a spouse as a lump sum, the spouse can roll that over into a rollover IRA and defer the income tax until they're forced to take it out at 70 and a half. So you typically want to name the spouse as the primary beneficiary in order to do the rollover. But then you name the trust as the contingent beneficiary. So it flows into your plan and goes where you want it to go, into trust for the children or not. Sometimes people will name adult children here because children can elect estate status for the IRA and spread the income tax over their lifetime. What I find most of the time is they take it. They don't extend it. They say, I want the money now. Thank you. So going into the trust is simple, easy. But be aware, if you don't do these two, this can be a big part of the plan. Got a lot of people with huge rolled over 401k plans into rollover IRAs, and it's a significant percentage of the estate. And nobody's looked at the beneficiary designation. It still says prior spouse. And current spouse says, I don't think that's where we want it to go. So you've got to look at that as part of the plan. 3 other documents you want to have. First is what's called the durable power of attorney for property. The revocable trust works on anything inside the trust. The will deals with property outside of the trust if you die. What if it's outside of the trust and you're just incompetent? You're in the coma from the auto accident. The power of attorney allows the attorney, in fact, to deal with that asset. And you typically give them a power to put it in the trust so you avoid probate. And you name the same person to be attorney, in fact, as you've named as executor or trustee. It's just a backup to the trust to make sure everything gets in. It works 95% of the time. The 5% is typically with insurance companies. The one we ran into, spouse is incompetent, hit his head on a rock at a ski resort. Spouse said, insurance company said, we're liable. Here's a check. We'll pay. Spouse said, fine, I'll sign the release. Insurance company said, no, you won't. We want a court order. We don't trust powers of attorney. We want to know we don't owe anybody else once we get this thing done. So we had to go to court, and that's where the nomination of conservator comes in. That's the court-appointed person for an incompetent, just like an executor. But it's a pain to get and expensive. So you want to try to avoid it as much as possible. It's like $10,000 just to get the thing set up, and then you've got to do accountings every year. It's terrible. But you have it because it's a last resort. Last item, Advance Healthcare Directive, the pull the plug document. Not related to your property, but to your health care. Who's going to make health care decisions for you? It's very often not the same people who are good financial managers. Much more intimate kind of decision, often different for each spouse. If you have a health care document that's more than 2 years old, I would recommend going in and getting it updated. It's not critical, but they passed something called HIPAA, Health Insurance Portability Act. They terrified the medical community. They told them there was a $50,000 fine and a year in jail if you released medical information without written consent. And then they said written consent means this, typical overwriting. The old healthcare documents didn't necessarily refer to HIPAA. The question was, were they strong enough to satisfy the doctor or the hospital when you went to them and said, I'm the agent for healthcare, give me the data? And they say, no way. Go give me a HIPAA form. Well, anybody who's been in the hospital has probably signed one of these HIPAA forms when you went in, if you've been there or to a doctor in the last couple of years. What most attorneys are doing, I think, is you don't see it in the CMA form, but we're putting in language that says references HIPAA and lays out in words, yes, the agent has health care authority under HIPAA, and when you're arguing with the insurance company about coverage, you can get the data from the doctor or the hospital to prove to them that they underpaid or you got overcharged or something else. That's your set of documents. The pour-over will and the revocable trust, the beneficiary designations, durable power of attorney, nomination of conservator, advanced healthcare directive. You set it up with a bypass, maybe a Q-tip, a GST, maybe separate share, and you're in business. You've got the basic estate